Hello, everybody, and welcome to another edition of This and That, where we remind you to ask, should I react to those headlines? So in this edition, Reggie, Brett, and I are going to dive into a few things. First of all, the investor mindset. We're going to revisit that and see where we think some speculation is. So we're going to talk about what things we're avoiding right now. Talk about cycles and potential catalysts out there that we see in the market. And then we're going to even go beyond the basket, talk about investments that you can't find in an index, and review a trip that Reggie and I recently have taken, a research trip to discover a little bit more into a company. And then at the end, for our clients, we're going to have a where we stand segment to kind of review and update broadly. Clients' accounts are different, but so you can just kind of follow along with our thinking of how we manage money. And so appreciate your time. Hope you enjoy. I wanted to introduce everybody. Below me on my screen, I have Reggie McFadden. He's going to be with us today, sharing some knowledge. And then we also have, guess that's to my left on the screen, Brett Pope, and he's going to be in here kind of guiding us a little bit. He'll be asking some questions today, but it'll be pretty interactive as we go through this. So why don't you take it away, Brett, and we'll just get started where we are.
All right, so I thought first we could talk about what kind of mindset an investor should have. So if you want to comment on that.
Okay. Well, I'll go first, and I think what we say often is just to focus on that investor mindset, and that distinguishes it between gambling or speculation. And really, the difference to me is, well, I'll take gambling first of all, where either know nothing investor, you're playing with little sums, hopefully, and you're just kind of rolling the dice. And maybe you got to some what you think is an investment because you're following somebody else. But speculation to me is you know something and you're intelligent and you probably have a system that works out, but you really are relying upon a stock price movement to kind of make money. So you're going to be focused on shorter term horizons. You may use leverage, and you may even want to risk blowing yourself up and things like that. And maybe you got one account over here that you're speculating with, so there's a backup plan in case that one blows up. But in investing, we're talking about that investor mindset where you're thinking about how's that business operating underneath, and how do we invest? How do we allocate in a way that we can make money with the operations of the company underneath? And so that's what I think about with the investor mindset. Reggie, anything to add there?
Yeah, just when it comes to the speculation aspect, it's really kind of the fear of missing out, just because prices are going higher, or even from the company side of it is throwing all kinds of money at capex of fear of missing out on the next boom, from them thinking they got to one up the competitors just to get ahead. And I think you kind of see that in the market a good bit today. Just prices going higher, and people fear they're missing out on the next big bull market.
Yeah, it's hard to keep that's really, I think, the main point of us talking about investor environment, investors mindset, is that fear of missing out. And Buffett talks about, baseball and you're getting a pitch and you don't have to swing. And that's really the investor mindset, is that, okay, maybe things are running away in some certain area of the market. There's a lot of excitement, but the reality is if you're investing, you don't have to swing at that. If you're speculating or, gambling, but really back to speculation, you have to chase the movement of prices. You want price movement to be able to make any money. But like I said, if you're the investor, you're going to make your money, try to make your money off of the operations of the business.
Yeah, and I think that brings it back to October 2011. One of the dis and dats was try to be a long-term investor. And so rather than focus on price, you had a good chart back then from 1999 and where we are now, and back then in 2011. So I kind of just wanted to revisit that, just from, instead of focusing on price, kind of where we are just in the market. And from the chart you had back in 2011, you can see the back in 99, the price of gold was $279 an ounce. And, the yield was almost 6% on the money market. And then you go down and you look at kind of where the S&P was back then. And, the dividend yield was only about 1.1%, and you had a forward earnings yield of 3.5%. So we fast forward or backtrack to 2011, price of gold was, around 1,600, and the S&P dividend yield was 2.25 thereabout, and you had a forward earnings yield of 9.1%. So back then prices looked a lot cheaper. And then now we look today, and we're basically back to 99 levels on the dividend yield and earnings yield. So instead of just worrying about price, it's really thinking about, at these current levels, what is the forward expected return? And if you're just buying the, S&P 500, it looks pretty bleak compared to 2011 and back to levels of 99. And so then, Oh, go ahead.
I was going to say, are there any current trends in the market that you're paying attention to?
I think, to me, it's obviously the AI boom that has gotten a lot of the headlines. And then you try to think about market cycles, and currently, if you're just buying the S&P 500, the top 10 stocks hold almost 40% of the weighting. So every dollar you put in is 40 cents is going to just 10 stocks. And if you think about 99, I mean, the top 10 was 23% of the, top 10. So it's gotten to a real peak of basically you're having 10 stocks drive this whole market action. And, I don't know if you're saying it's going to crash like 99, but it's just definitely something you want to be aware of.
Yeah, and I think, back to the investing part, where it's not that you have to predict these cycles. Again, you don't have to participate in the AI revolution, and you'll be just fine. So what are we talking about if we're not talking about predicting cycles? What you can do is avoid it if you think there's a mania here. And that brings you back to investing. But to us, one of the problems nowadays is that indexing, especially large cap US index, has become so popular. There's a conventional wisdom, I think, right now, is because Buffett blessed indexing in 2013 or something. But the problem with indexes is that they change. This isn't the same index as 2013, as Reggie just described there. And so anybody, to me, buying the index today is not investing. I mean, you're either gambling, you don't know what you're doing because somebody told you, hey, I need to go out there and put money and I don't know what to do. So indexing is the hot thing now. And you don't realize that it's concentrated right now into an area that is overpriced or priced to perfection. And again, you don't have to predict this cycle, but if you want to invest, um, you can't invest by saying, okay, AI is going to take over the world. That's not an investment, that's a speculation.
And I think on top of that adds to, the passive indexing, which, like you say, goes back all the way to 2013 when Buffett was mentioning it. But you have these large passive inflows that just drive this market higher. Because, like I said, all this passive capital is basically buying, 40 cents of the top 10 stocks. So it just kind of feeds on itself until it doesn't. And like James was saying, you don't have to predict it. It could go higher. It's not that. But biggest thing is avoiding it and trying to be more of an investor instead of chasing prices.
Yeah, it's just hard to earn back your money if you're paying, I don't even know what the prices are, 100 times sales on something, or, I mean, you're not going to get 100% profit. So take you more than 100 years. So some things are, just companies that are caught up in that AI craze, and that not necessarily those top ones in the S&P 500, but things that throw an AI name on the company and they hope for something way down the road, or hope to get bought out because they have AI in their name.
Do y'all have any, I mean, we've kind of talked about what to avoid, the kind of mindset to avoid. Do y'all have any favorite characteristics that y'all really like of a mindset that an investor should have?
Again, to me, we have characteristics of our favorite investments. So if you think about that, you would go down the road 30 years and say, hey, and with that hindsight, what type of investments probably have done the best and that an investor could hold on to. And so first, you, as an investor, there's so much noise, you have to know what you're investing in. I mean, there's no way around it. If you don't know what the company is, and usually work for it, bought the product as part of your work, see your budget go into it every day, it's hard to keep the mindset that you're investing. So to me, that's the first characteristic. You have to know what you want. Second is you want a company, as Buffett says, with a wide moat, a strong competitive advantage somewhere. And really, as an investor, you're judging that all the time more than just where's the stock price going. So you're monitoring, is their moat getting bigger or is there competition coming in? And so you want a company with a strong competitive advantage. Now, that competitive advantage can be eroded, and so you need strong management there. You need management, usually if you can, it's proven that they're capable, that they have an investor mindset. They're not just there trying to finish off the last 5 years of their career, make as much money for themselves as possible, and then turn it over to somebody else. So they're really engaged in what they think is the meaning of the company, the good that it's bringing to society. And so to us, because there's so much turnover, so many cycles in the markets right now, disruption. You want to try to think of the company being in an industry also that's long term. It's trying to avoid the horse and buggy industry or something like that. And so that's gotten a lot more complicated nowadays. And then to me, the really last thing, which if you have these companies that check all of these boxes so far, again, going down the road and in hindsight, 30 years, and then looking back, the best companies probably would have had those. The problem is a lot of people know that and the price is high. So if you want to invest, you also have to get that price where you think it's gives you a big margin of error on what your value calculation is, because value is hard to figure out precisely. And so it's more of a horseshoe thing. So you want to me, as investing instead of speculation, you want to be conservative on that and have some room for error. Because unless you're CEO of the company and the founder, there's probably things you don't know about the company, even the people who sit on the board and things like that. So
Yeah, and I
that
think
to me
it's
is,
also important to think about, just your personal situation and try to block out some of the noise. CNBC and all that, they try to build excitement to sell ads. And if you see it, I mean, even back in financial crisis, then they try to fear you into doing something as well, just because they can sell ads, the more eyeballs they get. So just because they're talking about certain stocks on TV doesn't necessarily mean it's good for you.
And so when in a like I guess whenever there's a lot of outside noise, I mean a lot of investors feel a little anxiety, like the FOMO and stuff like that. How do you think would be best to kind of handle or push that away, not pay attention to it?
yeah, it's hard. Yeah, y'all two both do it very well. To me, one of the things is just diving into the financial statements. Um, that separates out, because that's boring. You're not going to get any viewers watching you go through a financial statement or anything.
Hmm.
So that 10Ks and things like that, they're all the um, reports, conference calls that you can read, things like that. So you really try to develop firsthand information about the company itself and not take the opinions of others.
Yeah, it goes back to, like you said before, know what you're investing in and be able to understand, the companies that you're investing in.
Recently y'all took a trip to the with St. Joe in Florida. Do y'all have anything y'all would like to share? Anything y'all learned on that trip or anything like that?
Well, I'll kind of start it off from my end and let Reggie go through a little bit more. But it was for a couple of years we've gone to the annual meeting, and to me, I don't attend a lot of annual meetings, but it's a company that you need to go kind of see, because of a lot of it's land based, and um, to understand what the company is. But at the meeting, it's very fundamental investor type things in the crowd. And so Reggie and I met one guy, and he said, "Hey, trying to put together a group outside of the meeting, outside of anything to do with Joe, and talk to some leaders of the community down there, and try to just gather what their thoughts are and what the direction for the area is. And so I'll turn it over to Reggie.
Yeah, I think, we've been a couple times and met with management, been to the annual meetings, and it was all kind of driven by the company. And so this time was a little different. We had met with kind of the community leaders and economic development committee, and just so seeing it from a different angle of this public-private kind of partnership that they have that's really driving the area. And, we got management side of it, but to see the community and, what they think of St. Joe and how they run their business, and getting those two pieces together to really benefit the stakeholders as a whole, not the shareholders, but just everyone involved in the area, from the companies to the government to the small businesses, and getting everybody on the same page can be, something it's pretty powerful.
Yeah, and so just to add to that, we met with the head of the Economic Development Committee, went to the airport, met with the CEO there. So he described kind of his pain points and his outlook for the future. And then we met with a trade school, so they're teaching the young minds to get some jobs in that area, and they find it easy to kind of place their graduates. And then a lot of it's travel, at this stage, tourism. And so they built a new sports facility, and we met with the people making the decisions there and what they're seeing and how they're expanding. And so it was really interesting, kind of off that thing. I don't know, Reggie, what there's 6 investment managers kind of with our group maybe, and I think 3 of them had actually moved to that area, so from Tennessee, New York, New Jersey, something like that, and they started researching it just like Reggie and I have, but they found it so enjoyable that they moved to the area.
Could you tell me a little bit about?
Just sorry, one more thing to add, that back to it of kind of the company and the public partnership is, you hear about the migration to Florida from high tax states such as New York, and it's like the understanding of where their growth is coming from, and just recently they added a direct flight from Northwest Florida Airport to LaGuardia, nonstop, and it was going to be kind of a trial run, but they had so much excitement about it, and that they've kind of gone full time. So I mean, that's just something you see that is not necessarily company specific, but seeing how they're seeing the growth, and the government, the public is really kind of driving decisions to help that area flourish.
Yeah, and there was a lot of positive comments from those people, and even we met with a small public-private board there. I'm not sure, I don't remember what the exact purpose was, but Joe as a community participant, the tourists and the residents, they're both held Joe in high regard.
And Could you tell us a little bit about like what Joe is, like where is it located, or kind of what they do? I know you said they have land, like real estate, but it sounds like they do a little bit more than that.
Yeah, I'll start the first part again and just to break it up and let Reggie take it. From what I understand, you have this uh, maybe third generation timber farm, and land was all over. Maybe about a third generation running it. They're not as excited as the first generation, and the timber industry's changed. They had a paper company, things like that. But the land was all scattered out. There was debt on it, and then the financial crisis hit, and so there was a fund manager who has ties in South Florida that knew about it, had a different plan of operation, and he this fund manager became I have to say it famous in the 90s. I think it was a fund manager of the decade of the 90s from Morningstar, and but he wanted to reorganize the strategy there after the financial crisis, and so put a large amount of his fund into the Joe Company and started on the process of uh, redesigning it, getting a plan from the joint counties. There's so much land that they had to do both of it, but he sold off land that wasn't focused in that area and started on this path. And he was chairman and CEO, and since then has kind of graduated his way out of that. So go ahead, Reggie.
Yeah, it's just known as kind of a land company, but they've really focused on expanding operations way beyond that. They have the hospitality business, whether it's the restaurants, the club members, then they've just kind of really diversified their earnings into more commercial. They have, like I said, the hospitality. They still are developing communities and just kind of focused on growing that area out.
And so it's in Northwest Florida. I think the headquarters that you can drive by and miss it is in Panama City. Um, and so they aligned with us because of the conservative nature of the management, and of course when you do the stock price to a acre of land, it just kind of sticks out that the stock price is discounted because of, I guess, a lack of liquidity so far. So if you have an investor mindset, it kind of aligns with that. And they got out of debt and do some stock buyback. So they do things that are shareholder friendly in our mind.
Sounds very interesting. Did y'all have any thoughts y'all would like to share on the market as a whole? I know we already kind of talked about it. I didn't know if we missed anything that y'all wanted to add.
Yeah, I mean, I'll go first because to me, I'm back stuck on this index thing and kind of beyond the basket thought, and did write about it a little while back on the this and that. But you have some areas. So if you have excitement in an area, I don't want to call it a mania. I don't know what that is, but there's definitely excitement in that AI, and the prices have made it to where the way the index works, it's a high concentration at possibly the worst time. So it's the opposite of a margin of safety in those stocks. And that's where you're putting the most amount of your money if you buy that index, is in something that probably doesn't have a margin of safety, margin of error in the value calculation of that those companies 30 years from now, 10 years from now, whatever it is. But when that happens, money has to come from somewhere. And so to me, you have that in the big large cap US companies right now where there's a overexcitement. You have the same thing in private markets where there is private credit. I mean, it's what from Yale pension fund in the 90s started doing that. Now everybody, it's become the in thing to have private credits and private markets, private equity, and to companies that aren't traded on a stock exchange. And so they have created some regulations that may make it more beneficial to not become public. But to me, that's an area when you're looking at micro caps that is underpriced. So that's one area. And then maybe international's just been so beaten up for so long. But I think the gold bugs are out there. Gold's still one of those that's hard to evaluate from an investment standpoint because no cash flow. And so that to me is kind of what I see overall in the markets. And so I think, back to that investor mindset, part of it's just a little bit of conservatism versus the word and the approach of a speculator or a gambler. To me, I would be cautious in having too much money in those large U.S. index funds if you're only doing it because it went up in the past, because I think the possibility that your expectations are not met is getting very, very high. So you probably will be disappointed if you think the index fund's going to do 15% a year. From here, looking at the concentration and the value of those AI stocks, it seems highly unlikely.
Yeah, I think you're seeing a real, call it, dislocation in the market. You got all this capital running to AI, and that is adding a large amount to GDP, and you have kind of the rest of the 490 stocks that probably been in a recession for a while. You see the jobs reports, et cetera, and you get this real capital flow into the building out these data centers, et cetera. And, from a revenue standpoint, it's not really generating revenue now. And you have this CapEx of building these data centers out that you don't know when. I mean, technology moves so fast that they could be obsolete by the time they get done building. And so you have really kind of two different markets of one that is probably in a recession, and then two, just everybody running to AI stocks. And so it's kind of a weird place right now when you kind of look at it from that standpoint.
Thanks everybody for watching. Brett, Reggie, and I look forward to bringing you more videos like this. Until then, we'll see you later. Be safe and keep that investor's mindset.